You're sitting at your kitchen table, tax documents scattered everywhere, and you're staring at a number that makes your stomach drop. $42,000 in federal taxes. Gone. Just like that. You worked all year, sacrificed weekends, missed your kids' baseball games, and the government took $42,000 before you even saw it. Meanwhile, your neighbor just bought his third rental property, drives a Range Rover, takes his family to Europe every summer, and somehow, according to him, he paid less in taxes last year than you spend on groceries. That doesn't make sense, except it makes perfect sense, because there are two tax codes in America, one for people who earn money, and one for people who own assets. You're playing by the first set of rules, he's playing by the second. And the gap between those two games is the difference between working until you're 70 and retiring at 50. My name is Alex, and for the past decade, I've been reverse engineering how wealthy people legally pay almost nothing in taxes while building generational wealth. And what I found is that the entire system is designed to reward one behavior above all others: owning assets and never selling them. If you want to understand how the top 1% actually operates, make sure to hit that subscribe button and give this video a thumbs up, because what I'm about to show you is the exact playbook they use. And in July 2025, Congress just made this strategy dramatically more powerful. Here's the thesis. The wealthy don't avoid taxes through sketchy offshore accounts or illegal loopholes. They avoid taxable events. Selling triggers taxation. Borrowing triggers nothing. And when they die, their heirs inherit everything with a stepped-up basis, meaning decades of gains vanish from the tax records forever. This isn't a loophole. This is the system working exactly as designed. And I'm going to show you how it works, why it works, and how you can start using it even if you're not a billionaire. But first, we need to understand the fundamental divide that separates workers from owners. When you earn a paycheck, you're taxed on income. The money hits your bank account already reduced by federal taxes, state taxes, Social Security, Medicare. You never even see the full amount. You earn $100,000, you might take home $70,000. That's the worker's reality. But when you own assets, you're only taxed on realization. And here's the thing, realization is optional. An asset can appreciate from $100,000 to $10 million, and as long as you don't sell it, you don't owe a single dollar in taxes. That's not a bug, that's a feature. The tax code rewards people who accumulate and hold. It punishes people who earn and spend. Now, you might be thinking, okay, but eventually you have to sell the asset to use the money, right? That's when they get you. That's exactly what the system wants you to think, because that's not what wealthy people do. They never sell, they borrow. Here's how the borrow until you die strategy actually works. You buy an asset. Could be real estate, could be stocks, could be a business. That asset appreciates over time. Let's say you bought a house for $400,000. 10 years later, it's worth $1 million. You have $600,000 in unrealized gains. If you sold that property, you'd owe capital gains tax on those gains. 15 to 20% federal, depending on your income bracket. Plus state taxes in most places. You could easily lose $150,000 to taxes, so you don't sell. Instead, you borrow against the equity. You go to a bank and you take out a loan using the property as collateral. The bank gives you cash. You can spend that cash however you want. Buy another property, fund your lifestyle, pay for your kids' college, whatever. And here's the critical part. Borrowed money is not income. Debt is a liability. It's not a taxable event. The IRS doesn't tax you on borrowed money because you're obligated to pay it back. So you just pulled hundreds of thousands of dollars out of an appreciating asset and you owe zero taxes on it. Let me give you a concrete example. You own a house you bought for $400,000. You still owe $200,000 on the mortgage. The house is now worth $500,000. You do a cash out refinance. The bank appraises the property, agrees it's worth $500,000, and offers you a new loan for 75% of that value. That's $375,000. You use $200,000 to pay off the old mortgage. You pocket $175,000 in cash, tax-free. You didn't sell anything. You didn't trigger a taxable event. You just extracted equity, and the IRS has no claim on it. Now, you're paying interest on that loan, sure. But if you're smart, you're using that borrowed capital to buy another asset that appreciates faster than the interest rate. And that new asset generates more equity, which you can borrow against again. This is the compounding loop. Cash flow builds equity. Equity unlocks tax-free borrowing. Borrowed capital buys more assets. More assets create more equity, and the cycle repeats. Now, I know what you're thinking. But Alex, you still have to pay back the loan eventually. And yes, technically you do. But here's what most people miss. The asset pays the loan, not your salary. If you borrow against a rental property, the rent covers the debt service. If you borrow against stocks, the dividends cover the interest. And if you're really strategic, you're repaying that debt with depreciated dollars. Inflation is working in your favor. You borrowed money in 2025. You're paying it back in 2035 with dollars that are worth less. The purchasing power of that debt shrinks over time. Meanwhile, the asset keeps appreciating. And here's where it gets even better. Let's say you never pay back the loan. Let's say you just keep borrowing and refinancing and rolling debt forward until you pass away. What happens then? Your heirs inherit the asset. And under current tax law, specifically Internal Revenue Code Section 1014, they receive what's called a step-up in basis. That means the asset's cost basis, for tax purposes, is reset to its fair market value on the date of your passing. If you bought a property for $400,000 and it's worth $5 million when you pass, your heirs inherit it with a $5 million basis. All those gains, the $4.6 million in appreciation, are never taxed. Not by you, not by your kids, not by anyone. Decades of wealth accumulation, completely erased from the tax records. The debt gets paid off from the estate, usually by selling other assets or using life insurance proceeds, and your heirs walk away with a stepped-up, tax-free asset. This is how generational wealth actually works. It's not about earning more, it's about owning more and never triggering realization. Now let me show you how billionaires use this exact playbook. Elon Musk takes a $1 salary from Tesla. Mark Zuckerberg takes a $1 salary from Meta. Jeff Bezos took a salary of around $81,000 for years, even while Amazon made him the richest person on the planet. Why? Because salary is taxed as ordinary income. The top federal rate is 37%. That's the sucker's rate. Instead, they take their compensation in stock. Stock appreciates. They don't sell it. They borrow against it. Securities-backed lines of credit. The bank looks at their stock portfolio, values it at, let's say, $10 billion, and offers them a loan for $2 to $3 billion at an interest rate of maybe 2 to 3%. They take that loan. They fund their lifestyle. They buy more companies. They invest in more ventures. And they owe zero taxes because it's debt, not income. The stock keeps appreciating. They keep borrowing. And when they pass, their heirs get the step up. The gains are never taxed. This is why wealthy people fear taxable events, not debt. Selling triggers capital gains tax, 15 to 20% at the federal level, plus the 3.8% net investment income tax if you're a high earner, plus state taxes. In California, you could be looking at 33% total. Borrowing triggers nothing. Debt is a tool. It's leverage. It's how you turn unrealized gains into spendable capital without giving the IRS a cut. And here's the part that's going to blow your mind. On July 4th, 2025, Congress passed the One Big Beautiful Bill Act. It's been called OBBBA in the tax world. And buried in that bill are two provisions that make this strategy dramatically more powerful. First, the estate tax exemption was permanently raised to $15 million per person. That's $30 million for a married couple. Before this, the exemption was scheduled to drop back to around $7 million in 2026. Now it's locked at $15 million. That means you can transfer $15 million to your heirs without paying a single dollar in federal estate tax. And remember, those heirs get the stepped-up basis. So not only do they avoid estate tax on the first $15 million, they also avoid capital gains tax on all the appreciation. It's a double tax advantage. Second, and this is huge for real estate investors, the OBBBA permanently restored 100% bonus depreciation. Let me explain why this matters. When you buy an investment property, the IRS lets you depreciate the building over 27.5 years. Depreciation is a paper loss. You didn't actually lose money, but the IRS treats it as a deductible expense. So if you buy a rental property for $500,000, the land might be worth $100,000 and the building $400,000. You can deduct roughly $14,500 per year in depreciation. That's a tax deduction that reduces your taxable income. But here's where it gets interesting. Through a process called cost segregation, you can reclassify parts of that building as personal property instead of real property. Things like appliances, flooring, cabinetry, electrical systems. Those components can be depreciated much faster. And under bonus depreciation rules, you can take the entire deduction in year 1. Before the OBBBA, bonus depreciation was phasing down. It was 100% in 2022, 80% in 2023, and scheduled to keep dropping. Now it's back to 100% permanently for property acquired and placed in service after January 19, 2025. A cost segregation study typically identifies 25 to 30% of a property's value as eligible for accelerated depreciation. So on a $500,000 property, that's $125,000 you can write off in year 1. If you're a high earner in the 37% federal tax bracket, that's $46,000 in tax savings in 1 year. But wait, there's a catch. Normally, passive losses from rental properties can't offset your W-2 income. The IRS classifies rental income as passive, and passive losses can only offset passive income. So if you're a doctor making $300,000 a year and you buy a rental property that shows a $50,000 paper loss from depreciation, you can't use that loss to reduce your W-2 taxes. It just carries forward until you have passive income to offset, unless you qualify for an exception. And the big one is called material participation. If you materially participate in your rental activity, the IRS reclassifies it as active income, and active losses can offset W-2 income. The easiest way to qualify for material participation is through short-term rentals. If you rent a property for an average stay of 7 days or less, like an Airbnb, and you or your spouse spend more than 100 hours per year actively managing it, and more than anyone else, you meet the material participation test. Now your depreciation can offset your salary. This is the short-term rental accelerator strategy. You buy a property. You run it as a short-term rental. You do a cost segregation study. You write off $125,000 in year 1. That reduces your taxable income from $300,000 to $175,000. At the 37% federal rate, you just saved $46,000 in taxes. And here's where the snowball starts. You take that $46,000 you would have paid to the IRS, and you use it as a down payment on a second property. That second property generates more depreciation. More depreciation means more tax savings. More tax savings means more capital for the next property. You're compounding your wealth with money that would have gone to taxes. You're using the tax code as leverage. Let me walk you through a real example. You make $100,000 a year at your W-2 job. You buy a $500,000 short-term rental. You put down 25%, that's $125,000. You get a mortgage for $375,000. The property generates $3,000 a month in gross rent. That's $36,000 per year. Your mortgage payment is around $2,000 a month, so $24,000 per year. Property taxes, insurance, maintenance, call it another $6,000. You're breaking even on cash flow. But here's the magic. You do a cost segregation study. It finds $125,000 in bonus depreciation. You materially participate, so that loss is active. You write off $125,000 against your W-2 income. Your taxable income drops from $100,000 to negative $25,000. You pay zero federal income tax. In fact, you create a net operating loss that carries forward. Year 2, the property keeps generating cash flow. You might have another $10,000 in regular depreciation. Year 3, same thing. Meanwhile, the property is appreciating. Let's say it goes up 5% per year. After 5 years, it's worth $638,000. You refinance. You pull out $100,000 in equity, tax-free. You use that to buy a second property. Now you have 2 properties generating depreciation, 2 sources of equity growth, and 2 assets you can borrow against. By year 10, you own 4 properties. Your net worth is over $2 million. You've paid almost nothing in taxes because you've been offsetting your W-2 income with depreciation and financing your acquisitions with tax-free cash-out refinances. And when you pass away, your heirs inherit all 4 properties with a stepped-up basis. They can sell them immediately and owe 0 capital gains tax. Or they can keep them, continue the strategy, and pass them to their children with another step up. This is how dynasties are built, not through income. Through asset accumulation, strategic debt, and tax-free transfers across generations. Now here's the thing. You might be thinking, this sounds great for people with millions of dollars, but I'm not there yet, and that's fair. But here's what most people miss. Real estate is the accessible entry point. You don't need millions. You need one property. One short-term rental can create enough depreciation to eliminate your entire tax bill, and the tax savings you generate can fund the next property. Stocks require millions to generate meaningful borrowing power. A securities-backed line of credit usually requires at least $500,000 in portfolio value. But one rental property with a cost segregation study can save you tens of thousands in taxes in year one. That's your leverage. That's your starting point. And if you're sitting there thinking, but I don't want to manage an Airbnb, I hear you. But remember, you only need to materially participate. That's 100 hours per year. That's less than 2 hours per week. You can hire a property manager to handle the day-to-day. You just need to be involved enough to meet the threshold. Coordinate bookings, approve pricing changes, handle guest communications. It's not a full-time job. It's a part-time commitment that can save you more money than a second job would earn you. The real magic happens when you understand the compounding loop. Most people think linearly: earn money, save money, invest money, pay taxes along the way. But the wealthy think in loops. Cash flow builds equity. Equity unlocks borrowing. Borrowed capital buys more assets. More assets create more depreciation. More depreciation reduces taxes. Retained taxes become down payments, and the cycle accelerates. Each rotation through the loop increases your leverage, your tax savings, and your wealth. You're not climbing a ladder, you're spinning a flywheel, and every rotation makes the next one easier. Now let's talk about what happens when you connect this to currency debasement, something I covered in a previous video. The dollar loses purchasing power over time. Inflation averaged around 3% per year over the last 50 years. That means the value of a dollar today will be worth about 74 cents in 10 years. When you borrow money, you're borrowing in today's dollars. When you pay it back, you're repaying in tomorrow's depreciated dollars. If you took out a $300,000 loan in 2025 and you're paying it off over the next 15 years, the real value of that debt is shrinking every single year. Meanwhile, your asset is appreciating in nominal terms. A house worth $500,000 today might be worth $800,000 in 10 years. Your debt stays the same. Your equity grows. Inflation is working for you, not against you. This is why wealthy people love debt. It's not because they're reckless. It's because debt denominated in a depreciating currency is one of the most powerful wealth-building tools that exists. You're essentially getting paid to borrow. The bank gives you money. You invest it in an appreciating asset. The asset goes up faster than the interest rate. Inflation reduces the real cost of repayment, and you never pay taxes on the borrowed capital. It's financial alchemy. And here's the part that nobody talks about. This system is not a loophole. It's not a glitch. It's working exactly as intended. The tax code was written to incentivize investment and asset ownership. Politicians want people to build businesses, buy real estate, create jobs, and stimulate economic activity. So they built a tax code that rewards those behaviors. Depreciation exists to encourage real estate investment. The step-up in basis exists to facilitate intergenerational wealth transfer without forcing families to liquidate businesses or properties to pay estate taxes. Capital gains rates are lower than income tax rates to encourage long-term investing. Every single piece of this system is designed to benefit asset owners. It's not unfair. It's just asymmetric. Workers and owners are playing different games with different rules, and nobody told you that you're allowed to switch games. So what does this mean for you? It means you need to stop thinking like a worker and start thinking like an owner. A worker optimizes for salary. An owner optimizes for equity. A worker pays taxes first and spends what's left. An owner defers taxes indefinitely through depreciation and borrowing. A worker sees debt as a burden. An owner sees debt as leverage. A worker retires when they've saved enough. An owner retires when their assets generate enough passive income to cover their lifestyle, and they never stop acquiring because the step-up means their heirs win even bigger. The shift is psychological before it's financial. You have to stop asking, how much can I earn, and start asking, how much can I own? You have to stop fearing debt and start understanding when debt is productive versus destructive. Credit card debt at 22% interest to buy depreciating consumer goods, that's destructive. A mortgage at 6% to buy an appreciating rental property that generates depreciation and cash flow, that's productive. One traps you, the other frees you. And here's the controversial part I need to address. Some people will say, but you still have to pay back the debt, so you're not really getting away with anything. Let me be very clear about this. Yes, you have to service the debt, but the asset or its cash flow pays the debt, not your salary. The rent pays the mortgage. The dividends pay the interest. And when the loan matures, you don't pay it off with earned income. You refinance it, or you sell a different asset, or your heirs pay it off from the estate and still walk away with more wealth than if you had never borrowed in the first place. The question isn't whether you pay the debt. The question is who pays the debt and with what. If the debt is paid by the asset's cash flow or by depreciated future dollars, you're winning. If you're paying it with after-tax W-2 income, you're losing. This is the owner's playbook. And as of July 2025, it's more powerful than ever. The estate exemption is locked at $15 million. Bonus depreciation is permanent. Interest rates have stabilized, so borrowing is predictable. And the real estate market has cooled from its 2021 peak, which means there are better entry points right now than there were 3 years ago. The timing is perfect. The tools are available. The strategy is legal. The only question is whether you're going to use it. So let me tie this all together, because when you see how these pieces connect, everything changes. You start by acquiring your first asset. Could be a short-term rental, could be a duplex, could be a small portfolio of dividend stocks. That asset appreciates and generates cash flow. You use cost segregation to create paper losses that offset your W-2 income. You pay less in taxes. You retain that capital. You use it to acquire a second asset. The second asset creates more depreciation, more cash flow, more equity. You borrow against that equity, tax-free. You use the borrowed funds to acquire a third asset. Now you have 3 sources of appreciation, 3 sources of cash flow, and 3 assets you can leverage. The compounding accelerates. Within a decade, you've built a portfolio worth millions. You've paid minimal taxes because depreciation has offset your income and your acquisitions have been funded with borrowed, non-taxable capital. And when you pass away, your heirs inherit everything with a stepped-up basis. The IRS never touches the gains. The wealth transfers across generations, growing larger each time because the step-up resets the clock. This isn't theory. This is how it actually works. This is the system, and you're already living inside it. The only difference between you and the people who are winning is that they know the rules and you're just now learning them. So here's what you need to do next. Stop optimizing for salary and start optimizing for ownership. Find your first asset. If you're not ready for real estate, start with dividend-paying stocks and learn about securities-backed lending. If you can handle the commitment, buy a short-term rental and run a cost segregation study. Use the tax savings to fund the next acquisition. Think in loops, not ladders. Build equity. Borrow against it. Reinvest. Repeat. And most importantly, shift your relationship with taxes. Don't ask how to pay less on what you earn. Ask how to earn less and own more. Because the tax code doesn't care about your hustle. It cares about your balance sheet. Your future millionaire self is counting on you to understand this. 10 years from now, you're either going to look back and wish you'd started today, or you're going to look back and realize this was the moment everything changed. The information is in front of you. The tools are available. The law is on your side. The only question left is what you're going to do about it. So let me know in the comments, what's the next financial topic you want me to break down? Estate planning, securities-backed lending, the full breakdown of material participation rules? Tell me what you need. That's what this channel is for. And remember, you're no longer the person staring at that tax bill wondering where it all went. You're the person who just learned how the game is actually played. Now go play it.